want to walk you through an official research paper from the Bank for International Settlements, often called the Central Bank of Central Banks. This paper is called the BIS Working Paper 1112, Trust Bridges and Money Flows. It explains why cross-border payments are still slow, expensive, and inefficient, and how global finance is redesigning the system using digital money and new settlement layers. The BIS starts with a fundamental idea. Money works because of trust networks. People trust the issuers, banks trust other banks, and trust determines who gets access to the system. When trust becomes fragmented or expensive, payments slow and costs rise. Inside a country, payments are efficient because there's one trusted settlement layer, the central bank. Across borders, there's no shared settlement assets, so banks rely on bilateral correspondent relationships. That's the real bottleneck. Not the speed, not the technology, it's the credit model, where banks expand trust and credit to each other, and pre-funding, where liquidity is parked overseas just in case they need it. Both trap capital, increase risk, and exclude the smaller players. A common misconception is that central banks can simply fix cross-border payments, but the BIS explains that that's just unrealistic. Central banks don't share jurisdictions, legal systems, or risk tolerance. There is no global central bank and therefore no global trust anchor. This is where the paper pivots. Tokenized money like tokenized deposits, wholesale CBDCs, and regulated stablecoins. It allows trust to move from relationship into rules and infrastructure. Instead of trusting institutions individually, participants trust the system itself. The BIS proposes a global marketplace where tokenized money can be exchanged across borders. This replaces thousands of bilateral trust relationships with neutral shared infrastructure. Liquidity meets liquidity, pre-funding without correspondent chains. This is the most misunderstood part. The BIS does not pick one coin, token, or company. It builds around asset types and functions, not brands. Based on this paper and broader BIS research, there are 4 asset categories that clearly fit this model. CBDCs, central bank digital currencies. The BIS is clearly focused on wholesale collateral digital currencies used for interbank settlement. These pivot finality, compliance, and monetary control. The second is tokenized bank deposits. This is one of the most important and least talked about components. Tokenized bank deposits are commercial bank money represented on shared ledgers, fully regulated and fully backed one-to-one. This allows banks to operate on new rails without giving up control. The third is regulated stablecoins, strictly controlled. The BIS allows for regulated, fully backed stablecoins, but only under strict oversight. They are treated as instruments with the system, not replacements for sovereign money. Neutral bridge or liquidity assets. The BIS does not name a specific asset, and that's pretty intentional. But it clearly describes the need for neutral settlement mechanisms that can move liquidity between different tokenized monies without jurisdictional bias. This is where the function of bridge assets come in. Assets like XRP are often discussed not because the BIS endorses them, but because they already perform this function. The BIS does not endorse Ripple, XRP, or any private company. It defines the architecture. The market competes to fill those roles. No single asset replaces the system. This paper explains why progress feels invisible. Infrastructure is built first. Rules come next and liquidity flows last. Retail watches price. Institutions watch plumbing. It's how global finance evolves slowly, structurally, and quietly. The biggest mistake people make is waiting for the noise before understanding the system.